Today we are talking about one of the most famous investors in the world, Peter Lynch. He was the manager of the Fidelity Magellan Fund from 1977 to 1990. In just 13 years, he grew the fund from $18 million to more than $14 billion. That means if you had invested with him, your money would have multiplied many, many times. So why was Peter Lynch so successful? Because he had a very simple philosophy: invest in what you know. He believed you don't need to be a financial expert or a Wall Street professional to pick good stocks. Normal people like us can also find amazing companies just by observing daily life. For example, if you see a shop always full of customers, or a product that everyone in your family is buying, maybe that company has a bright future. Lynch's idea was, the best stock tips are not in newspapers or on TV, they are in your own neighborhood. Another reason his ideas are timeless is because they are practical. He never believed in complicated jargon or secret formulas. He taught people to use common sense, do simple research, and stay patient. That is why even today, more than 30 years later, his book, One Up on Wall Street, is still a guide for investors around the world. So in this video, we will learn the core lessons from Peter Lynch, how he picked stocks, what mistakes to avoid, and how you too can become a smart investor.
Lesson 1. Invest in what you know. Peter Lynch's most famous lesson is this: invest in what you know. What does this mean? It means that many times the best investment ideas are not hidden in complicated reports or secret stock tips. They are right in front of you in your daily life. Think about it. Which soap do you use every day? Which biscuit brand is always in your kitchen? Which shop or mall is always full of customers? Which mobile app do you and your friends keep using again and again? These are not random observations. These are real clues for investing. Because if millions of people are using the same product, the company behind it is earning strong profits. Peter Lynch gave this advice to ordinary people. You already have an advantage. You see trends before experts see them. For example, if your kids love a new type of toy, or your relatives are all buying the same shoe brand, that could be a signal to check the company's stock. But remember, Lynch did not say just buy blindly. First, notice what you know. Then, study the company. How strong is it? How much profit does it make? What are its future plans? If both things match, your personal experience and the company's strength, then it may be a great investment. So, the lesson is simple. Use your eyes, use your common sense. You don't need to be a financial genius. The best opportunities are often right in front of you. Peter Lynch himself found many successful investments just by observing malls, restaurants, and products his family used. And you can do the same.
Lesson 2. 6 types of stocks. Peter Lynch says not all stocks are the same. If you want to invest smartly, you must understand the 6 basic types of stocks. This way, you know what to expect from them and how they fit in your portfolio. Let's break them down in simple words. 1. Slow growers. These are old, large companies that grow very slowly, like old utility companies or public sector giants. They give stable dividends, but don't expect fast growth. They are safe but boring. 2. Stalwarts. These are strong, established companies that grow steadily, faster than slow growers, but not too fast. Example, companies like Hindustan Unilever, Nestle, or Infosys. They are defensive stocks, good in both good and bad times. 3. Fast growers. These are small or mid-sized companies growing rapidly. They can multiply your money quickly. Example, a new tech company or a retail chain expanding across India. But they are also risky. You need to track them carefully. 4. Cyclicals. These stocks move in cycles with the economy. Example, airlines, steel, cement, automobiles. When economy is strong, they rise fast, but in downturn, they fall sharply. Timing is very important here. 5. Turnarounds. These are companies in trouble, but with a chance of recovery. If they bounce back, the stock can give huge returns. But if they fail, you can lose money. Example, a company with debt issues, but new management trying to revive it. 6. Asset plays. These are companies sitting on hidden assets, like land, real estate, patents, or valuable brands. Sometimes the stock price is low, but the hidden assets are worth much more. Smart investors spot these before the market does. Peter Lynch's advice is simple. Know which type of stock you are buying. Don't expect a slow grower to double quickly. Don't expect a cyclical to stay stable. Match your expectations with the stock type. When you classify stocks this way, you avoid confusion and you invest with clarity.
Lesson 3. Do your homework. Peter Lynch gives one clear rule. Never buy a stock blindly. Don't buy just because a friend, TV anchor, or WhatsApp group says it's good. If you don't understand the company, don't invest. So what should you do? Do your homework. Pinpoint 1. Understand the business. What does the company do? How does it make money? If you can't explain it in 1 or 2 sentences, then you don't really know it. Pinpoint 2. Check the balance sheet. Look at debt. A company drowning in debt is risky. Lynch says strong companies manage their debt well. Pinpoint 3. Check earnings and growth. Is the company making profits year after year? Are sales growing? A consistent track record shows strength. Pinpoint 4. Compare with competitors. If you like a company, see who else is in the same industry. Why is this company better? Why should customers or investors choose it? Peter Lynch's golden line is invest in a company the way you would buy a house. Check everything before you pay. When you research properly, you invest with confidence. And when the stock goes up and down, you won't panic because you know what you own.
Lesson 4. 10 baggers and long-term thinking. Peter Lynch used a very powerful word, 10 bagger. What is it? A stock that grows 10 times your original investment. For example, if you invest 10,000 rupees in a company and it becomes 1 lakh rupees, that's a 10 bagger. Lynch says, you don't need hundreds of stocks to become rich. Even 1 or 2 10 baggers in your portfolio can completely change your financial life. But here's the secret. Patience. These 10 baggers don't happen in 1 month or 1 year. They take 5, 10, sometimes 15 years. Example, Infosys. In the 1990s, it was a small company. Early investors who held it for decades became crorepati's. Another example, Asian Paints. A simple paint company, but people who held it long-term saw massive growth. The problem is, most people sell too early. They see 30%, 50%, or even 100% profit and run away. But Lynch says, the real wealth comes when you let the winners run. So, his golden lesson is, time in the market is more important than timing the market. So if you find a strong, growing company, don't be in a hurry to sell. Hold it, nurture it, wait for it to become your 10-bagger. That's how ordinary investors can become extraordinary wealthy.
Lesson 5. The power of patience. In the stock market, one thing is guaranteed: ups and downs. Some days the market will rise, some days it will fall. And honestly, these movements can make people nervous. But Peter Lynch reminds us of one golden truth: patience beats panic.
Most investors lose money not because of bad companies, but because of bad reactions. The moment the market falls, people panic and sell. Later, when the market rises again, they regret. Example: in 2008, the stock market crashed badly. Many investors sold their stocks out of fear, but those who held patiently saw the market bounce back stronger within a few years. Even during COVID-19 in 2020, the market fell sharply, but within months it recovered and reached new highs. Lynch's message is simple: short-term noise doesn't matter, long-term growth does. So if you have chosen good companies with strong business, don't panic when prices go down. Use patience as your biggest strength, because in the stock market, money doesn't move from the smartest people to the wisest people. It moves from the impatient to the patient. So remember, stay calm, stay invested, and let time do the magic.
Lesson 6. Avoid hot tips and fads. In the stock market, you will always hear people saying, "Ye stock le lo, double ho jayega in 6 months." Or, "This is the next big thing, don't miss it." These are called hot tips and fads. Peter Lynch clearly warns, stay away from them. Why? Because most of the time, these tips come without research. They spread fast like gossip, but vanish just as quickly. Example: many people in India bought random stocks during IPO booms just because someone said, "This is guaranteed profit." Some made quick money, but most lost heavily when the stock prices crashed later. Think about crypto or meme stocks like GameStop. Some early people earned, but most who blindly followed the crowd lost huge amounts. The truth is, if everyone around you is already talking about a stock, chances are the real opportunity is already gone. Instead of chasing hot names, focus on your own research. Buy what you understand, what you believe in, and what you are ready to hold for years. Because in investing, fads fade, but fundamentals last. So next time someone whispers a secret tip to you, just smile and remember Peter Lynch's advice. Your homework is stronger than any hot tip.
Lesson 7. Growth Stories and Fundamentals. Peter Lynch always believed that the best investments are often the simplest ones. You don't need a complicated formula. You just need a clear growth story and solid fundamentals. What is a growth story? It means the company has a simple reason why it will grow in the future. For example, a food chain opening more outlets across India, a mobile company launching affordable phones for rural areas, a pharma company making a new medicine that is in high demand. These are growth stories that anyone can understand. But growth story alone is not enough. You must check the fundamentals. Is the company making profit? Is the debt under control? Are sales and earnings increasing year after year? PANT's example. When Asian Paints was expanding across India, its growth story was simple. Every home needs paint, and more Indians were painting their homes. At the same time, the company's fundamentals were strong. Low debt, consistent profits. Result: long-term investors became very rich. On the other hand, many startups tell beautiful stories but have no profits, only losses. If the fundamentals are weak, the story can collapse. Peter Lynch's lesson is simple. Growth plus fundamentals equals a winning stock. So whenever you look at a company, ask 2 questions. Is the growth story simple and believable? And are the fundamentals strong? If the answer to both is yes, you might have found your next big winner.
Lesson 8. The Importance of Earnings and PE Ratio. Peter Lynch says, earnings are the heartbeat of a company. If earnings grow, the company grows. If earnings stop, the company struggles. But how do we judge if a stock is expensive or cheap? That's where the PE ratio comes in, price to earnings ratio. It simply means how much are investors paying for 1 rupee of the company's earnings. Example, if a company's stock price is rupees 200 and its earnings per share is rupees 20, then PE ratio equals 200 divided by 20 equals 10. That means investors are paying 10 rupees for 1 rupee of earnings. Now, here is the trick Lynch taught us. Don't just look at PE, compare it with the company's growth rate. If a company is growing earnings at 20% per year, but its PE is only 10, that is attractive. If another company is growing at only 5% per year, but its PE is 50, that is dangerous. The simple idea is called PEG ratio, price to earnings to growth. If PEG is around 1, the stock is fairly valued. If PEG is much less than 1, stock may be undervalued. If PEG is much higher than 1, stock may be overvalued. Example, suppose company A is growing earnings at 25% with a PE of 20, then PEG equals 0.8, then attractive. Company B is growing at 5% with a PE of 40, then PEG equals 8, then risky. Peter Lynch's message is simple. Don't just buy popular stocks, buy companies where earnings growth justifies the price. So, next time you see a stock, ask, what are the earnings? What is the PE ratio? Does the growth justify the price? This way, you invest with logic, not emotion.
Lesson 9. Mistakes to avoid. When it comes to stock investing, many people lose money not because of the market, but because of their own mistakes. Peter Lynch warns us about 3 big mistakes every investor should avoid. Mistake 1. Overtrading. Buying and selling too often. Many beginners keep jumping in and out of stocks daily, hoping to make quick profits. But the truth is, the more you trade, the more chances you lose. Brokerage costs, wrong timing, and emotional panic kill your wealth. Remember, investing is about patience, not speed. Mistake 2. Chasing hype. Everyone runs after hot stocks or trending companies. By the time you hear about it on TV or WhatsApp groups, the price is already high, and when the hype fades, the price crashes. Always remember, if everyone is talking about it, you are already late. Mistake 3. Ignoring research. Many people buy stocks just because a friend, relative, or broker suggested. But if you don't know what the company does, how it earns money, and what its future looks like, then you are just gambling. Peter Lynch says, invest in what you know and research before you invest. The lesson is simple. Don't try to act smart with quick trading. Don't run after hype, and don't invest blindly. Stick to research, patience, and discipline. That is how wealth is created in the stock market.
Lesson 10. The Lynch Mindset. Peter Lynch says, the best investor is not a gambler, but a detective. Investing is not about luck. It is about curiosity, patience, and research. Think like a detective. When you see a new shop crowded, ask yourself, who owns this company? Is it listed? How are its earnings? When you notice a new product everyone is using, ask, can this become a growth story? Stay curious. Most great investments are hidden in plain sight. You just need to observe and connect the dots. Stay patient. Stock market will test your emotions. Prices will jump and fall. But the real winners are those who hold strong companies for years. Remember, one 10-bagger stock can change your financial life, but only if you have the patience to hold it. Trust your research. Don't panic if others doubt you. If you have studied the company well, if the fundamentals are strong, then believe in your work. Peter Lynch's mindset is clear. Invest with eyes open, brain active, and heart steady. The market rewards not the fastest, but the most patient and the most consistent. Conclusion: investing made simple. At the end, Peter Lynch's biggest lesson is very simple. Investing is not rocket science. You don't need to be a genius. You just need common sense, patience, and discipline. Invest in what you understand. If you cannot explain in 2 minutes how a company makes money, don't invest in it. Simple rule. Think long-term. Markets go up and down every day, but wealth grows over years and decades. The longer you stay, the more compounding works in your favor. Let compounding do the magic. Even a small investment can grow huge with time if you allow it to multiply. Compounding is like a silent worker. It doesn't show quick results, but in the long run, it builds massive wealth. So don't chase hot tips, don't run after short-term profits. Build a habit, study good companies, invest regularly, and stay patient. Because in the stock market, the real winners are not the ones who know the most, but the ones who stay calm, think clearly, and play the long game. Peter Lynch proves investing can be simple if you keep it simple. Remember this golden line from Peter Lynch: stocks are not lottery tickets, they are businesses. When you buy a stock, you are not gambling, you are becoming part owner of a company. If the company grows, your wealth grows. If the company is strong, your investment is safe. So don't treat the stock market like a casino. Treat it like a marketplace of businesses. Study them, understand them, and invest in the ones you believe in. Because at the end, stock investing is not about luck. It's about knowledge, patience, and smart choices. And always remember, if you understand the business, you understand the stock. That's the real secret of long-term wealth.